Welcome to our first webcast of 2025. The year is starting in a really eventful way. We have had already a good amount of volatility across markets in fixed income and currencies. And clearly, we're seeing a shift in regime from what was a very, very stable policy environment to something that is going to be a lot more exciting and risky. So we have been thinking a lot about the policy and the market environment under Trump administration, under fiscal dominance. And together with my colleagues, since the mid of 2024, we were already anticipating this election result. Now it's really about understanding who will be the winners and losers from Trump policies and how will fiscal dominance move markets after 15 years of monetary dominance. So let's talk about what happened in the past and what's going to happen right now. We have three scenarios for 2025. In the past, we had a scenario of Goldilocks where central banks were controlling markets, inflation was low, and we had low taxes and low volatility. This scenario is going to evolve in something that's more volatile, where growth is still positive. There's still US outperformance, but inflation is a little bit higher. This is our base case. We're putting a 50% probability that Goldilocks is going to become more volatile. We don't think we are going back to where we were before. And what this means is that in an environment where deficits continue to be high, so 6.5% to 7% in the US, similarly to the CBO forecast, right, or even higher, deficits continue to be high. On top of that, you have tariff spending, inflation stays above target. It means the Fed put will be struck lower and will be a little bit weaker than before. And volatility can come equally from a slowing growth environment, but it can also come from wider long-end yields. Let's remember that the US economy runs on long-end yields, unlike the European economy. And one of the reasons why we didn't have a credit cycle, despite 500 basis points of Fed hikes, is that the long end of the curve, of the yield curve, remained inverted for a very long time in the US. So Fed forward guidance and also reductions in quantitative tightening kept the long end at bay and kept volatility at bay. This might be harder going forward. It is true that Scott Bessent has a lot of expertise and will probably handle Treasury issuance very well. However, we also know that Treasury maturities will go longer. There will be more supply. And at the same time, the anchor of global yields, the BOJ, is also hiking. And expectations for inflation might persist. On top of that, we have supply bottlenecks in the labor market, which is at full capacity. And that can entrench even a little bit more the expectations on services inflation. So a more volatile scenario is our base case, which will mean more dislocations, more opportunities, and more dispersion. We also have a couple of scenarios which are an amber and a red light. We started the year with a very, very concentrated consensus across investors. And it is worth flagging that there are things that can go a little bit rougher down the line. For example, if there are retaliations from other governments on tariffs from the US, so if there is a second round of tariffs, for example, from China, then we could have even a more persistent level of inflation and a more hawkish Fed. A shift of the Fed reaction function to a more hawkish one would mean more volatility, potentially some corrections across risk assets. It's also possible that there can be some accidents. We have a very one-way positioning in risk assets, especially in US risk assets. And there are several participants that have been very exposed to duration, very exposed to credit. So right now, at record tight levels of spreads, it's worth considering a scenario of even higher volatility, what we would call a hawkish conflict between fiscal dominance, between the government spending and a more hawkish Fed. And finally, we have a scenario where both engine of the economy start sputtering. The fiscal engine and the monetary engine, both of them lose some ground. It's not our base case, but it's worth considering hedging the tail for a slowdown in growth, where right now most investors never mention recession, never position for that, while 1 year ago, recession was the name of the game. We're not calling for that. It's not a base case, but the hedges for that scenario are very inexpensive. So a base case of more volatility with potential tails, that's how we're positioning in 2025. And let's talk about what we see happening in terms of policy measures and how we see the credit cycle and inflation, and then the opportunities in the credit market. So the first thing to keep in mind, fiscal dominance is about the deficit. Now, the Trump policy has been summarized in the rule of the three threes, 3% growth, 3% deficit, and 3 million barrels of additional oil production. We think it's really hard to achieve all these three objectives. And we think that the deficit will remain pretty high at 7%. As Milton Friedman said, there's nothing more permanent than a temporary government program. And the amount of federal employees in the government has remained pretty much stable over the last decade. What has grown a lot are state and local employees. It is much harder for the federal government to cut those. Any attempt to reduce regional spending across large countries will take several years. So it's very unlikely that we are going to see an immediate reduction in government employment in the first quarters of the Trump administration 2.0. So the deficit will continue to be high. And this is also why we do think that the long end of curves will continue to create some volatility, and the term premium is something to watch in 2025. Having said that, it's also very likely that U.S. growth will surprise to the upside from the Federal Reserve forecast of near 2%. We do think that U.S. growth would be closer to 3 than 2 in 2025, and there's several reasons to think that, and particularly one of them is public investment, which will come back, and we've already seen some announcements on that, both in infrastructure and in technology. And public investment will also be accompanied by private investment. We have had a pause in private investment hiring decisions over the past few months as people awaited for election results. On top of that, there are the tariffs. Now, how much capital can the tariffs raise? Well, it depends on how big they are and how broad they are. But we're looking at hundreds of billions. In an average case, we're looking at a few hundreds of billions. So they're not going to reduce the deficit massively, but they're going to be an additional spending that will go into the U.S. economy, and obviously capital that will be extracted, at least initially, from outside the U.S. So this will give an additional boost to the U.S. Fiscal spending, and we think the deficit, all else equal, with a given amount of deficit, this will mean more spending domestically, so more domestic growth. So the question is, how will all this work? Is this compatible with inflation being at target? And the answer is inflation will remain more sticky. Yes, the oil production can be capped and can be increased, and so the oil price can be capped, and that can cap the level where inflation can bounce at. But we think that there's a lot of dynamics in labor and services pointing to inflation staying at around the current level, so above target, so at around 2.5%. We're actually, in our base case scenario, we're looking at something that is closer to 2.7% for headline CPI at the end of this year. So closer to 3 for headline. And we also see a sticky core inflation. In the Eurozone, this problem is not there. So we started the year and we ended last year with the idea of a very dovish Fed, of disinflation, of some economists were forecasting 4 or 5 cuts. We don't have that. We only have 1 cut, which I think is fair. And we also have a continuation of quantitative tightening. And the two things cancel out. So we are in a liquidity neutral environment. We went from an environment with strong fiscal and strong liquidity easing last year to an environment where the liquidity engine is neutral and the fiscal engine is still positive. So we still see an environment of, a positive environment for risk assets and for credit, but one of the two engines is no longer accelerating. And in the base case scenario, that will create some volatility. If the fiscal engine sputters, or if the liquidity engine goes into hawkish mode, so if the Fed changes reaction function, then we'll see a little bit more widening, a little bit more volatility. How is the opportunity set? So having drawn the macro context, the liquidity and the fiscal context, what's the opportunity set in the US and Europe? And how do we navigate? How do we pick the winners and losers this year? I would say it's pretty exciting as a starting point. It's more exciting than last year. Why? Because the market is one-way positioned for US outperformance, for disinflation, for tight spreads, and for low volatility. So we're starting the year with a very, very optimistic assumptions about the Trump administration, but not only on growth, but also on the level of deficits, on the level of inflation. So, interest rates came down to below 4% last year on the 10-year. We've never been large buyers of duration. We've been leaning on the other side. And we do think that the rate widening can continue. Spread levels are at record lows. investment grade index, CDX investment grade index on the credit default swaps of the US investment grade market is at 47 bips. 47 basis points is just 2 bips shy away of record lows, all-time lows. And the US high yield market as well, the CDX high yield market is trading at close to 109, so 9 points above par. And the highest it's been in my career, it's 110. So we are very close to record tights and record highs, but positioning is also at record longs. This is DTCC data for the CDX, the US high yield market. It's a record long. Same for the US investment grade market, the gray line in this chart. Contrary to this, the positioning is opposite in Europe. Everyone has been very negative on Europe, on the challenges that Europe might face with the Trump administration and the tariffs. And as a result, investors have bought a lot of protection on European indices, bringing them to record short positioning and also wider valuations. Similarly, in the equity market, we have a similar picture. So it's consistent with what we see across other markets and across currencies. So there is potentially some opportunity in Europe when the US spends and also when Europe spends. The stimulus goes together. We'll talk a bit more about the upside for Europe, but let's remember that a lot of European firms have 40-50% of revenues in the US, in the major indices. And also that when Europe spends in some sectors, for example, in defense, 60% of that goes to US firms. So there's a lot of connectivity between European exporters and stimulus to the US economy, and also European fiscal and some sectors of the US economy that exports into Europe. And so it's hard to see the US growing well and having a sustained level of spending and Europe going into a recession at the same time. We do see from these very tight spread levels, we do see a widening because of the volatility that we're going to see, but we do not see a recession. We do not see a distress cycle or an increased default cycle. A lot of investors that we've been talking to over the past years have been waiting for a distress cycle, and they've been thinking that the Fed hikes would create a distress cycle. Not this time, because Fed hikes have come with a very stable and a very inverted long end. The Fed has only pulled the handbrake while pushing the accelerator at the same time, so kept the long end inverted. So we never really had a default cycle, a sharp default cycle, and we don't think we're going to get one yet. But we will see more restructurings. Last year, in the first quarter, we had Intrum, we had Ardagh, Grifols, Glencore, and obviously Altice, SFR. So 5-6 names above Atos as well. 5-6 names above 1 billion capital structure going into stress. We do see that more names will have to restructure this year. So defaults will continue to stay as at a medium level of 4 to 5%, but they will not be clustered and they will not explode to over 10% recessionary level. So it's still an interesting level of dispersion. There are good names, bad names, and ugly names, and the bad names will restructure more heavily. The ugly names will have to do amend and extend, and we'll have to probably do it again, because what's been done last year was in the hope of yields coming back to low levels. And if yields don't go back to 3.5% on the 10-year, these names will have to do it again. So sustained level of restructurings, but still a relatively benign cycle where we don't have distress in large sectors, in large amounts. And I would say this is exciting because we had 2 years of low volatility and of stable Goldilocks, where we were able to generate pretty good alpha. But right now we're going probably in an environment where the starting point is very low spreads, so very inexpensive protection for both the right tail and the left tail. And at the same time, we have dislocations and dispersions, which we have seen occurring already. Last year we had a large dislocation in August, and the previous year we had a banking dislocation in March and then a dislocation in November. This year, we expect more. We started with also very polarized opinions across the US and Europe and very polarized positioning. So we do want to be very well hedged right now. Being in anything that has a long bias does not really help. It's very hard to see it as a sustainable trade. But at the same time, within the universe of credit, where spreads have tightened a lot, there are interesting opportunities on the long and the short side. I would just discuss a few. I mean, on the long side, we continue to like sectors that do well in a sustained inflation, in a sustained growth environment, like energy, and banks, but also sectors that have been unloved, like the industrial and auto sector in Europe, have offered pretty good opportunities. We want to be more selective on the longs here. For sure, there are names that there's several names that have an upside catalyst, but for sure the beta of the market is less attractive, as discussed before. We also continue to be invested in Ukraine, both at the corporate and sovereign level. It is something that we flagged several years ago when the bonds traded in the teens, and we now have the near-term catalyst for a ceasefire agreement. It is already on the table with a bid-ask in terms of number of troops and the future capability of the Ukrainian army, which a bid-ask that is not too large. So we're happy that eventually this conflict is coming to at least to a pause, if not a structural ceasefire. And we've been invested in the country, both at the corporate and sovereign level. This is one of the things in the credit market that has most upside. Typically, however, we want to be the second level of loss risk in credit. So we want to be a bit more senior in the capital structure. We want to be a bit more high quality at this point in time in the cycle. And on the shorts, there is a lot of things to choose from. There's a lot of names that are extremely tight, both in the US and to some extent also in Europe, particularly in the investment grade. So the investors that have bought high quality credit have been buying essentially a rate product with very, very tight spreads, with double the maturities on average that investment grade credit had 20 years ago in the US market. So we're very sensitive to a backup in yields, and we're also sensitive to a slowdown in growth. We don't like the cusp of investment grade and high yield. We don't like those cyclical names that are trading at record tights, not because we necessarily see a credit market decline near term, but because the risk reward is pretty bad for you. And so we would definitely go into something that is more idiosyncratic, more alpha focused, and hedge the beta risk right now. So to conclude, we are still in a positive environment for credit and for risk assets, but valuations have gone very far. So we're looking at a volatile Goldilocks for 2025, where strong deficit spending, persistent inflation, and also the supply of long-end treasuries, can result into some volatility across rates and credit markets, and also across certain countries that depend on dollar funding. For example, in EM, we'll have a strong dollar, we'll have some volatility there. We think that the pricing of policy under the Trump administration has gone quite far. We do see upside in Europe. Europe will continue to spend, and will spend in a more organized way on infrastructure and defense. And we think these sectors have upside in Europe. We also think that a Ukraine ceasefire will be positive for the rest of Europe. Ukraine has roughly 25% of steel production in Europe. They have 15% of wheat and corn global production. They have double-digit global reserves of titanium and lithium. So a lot of agricultural strategic reserves and metal reserves globally, and they have a very young population with high education. So it is going to be an engine of growth if Ukraine gets closer to the Eurozone and the European Union. And if we have both public and private investment going into Ukraine, and many companies in Europe, from Ryanair to Rheinmetall, have already discussed the future of their future investment plans in Ukraine. So that's an additional catalyst that maybe investors have not priced in. Against this backdrop, I would say we're starting from a very polarized positioning environment. So in the US, I would say a lot of the upside is priced in. Perhaps there's a little bit of upside in the equity market, but not in the credit market. The credit market is very well priced. So there can be bumps, and these bumps will widen rates, will widen spreads in the US. It might become a buying opportunity later on, but in the US markets, we're very, very well priced in. And also in emerging markets, with a few exceptions like Ukraine. In Europe, on the other hand, positioning is very negative. So when we find buying opportunities in Europe, when we have risk events in Europe, typically this short positioning caps the downside of spreads. So some of our longs continue to be in Europe. We don't see the same upside in the UK, where the policy mix is still not addressing structural issues. But if we talk about continental Europe, we do see very negative positioning and some points of upside that have not been captured by investors. So it's a pretty exciting environment. I would say that contrary to the last 2 years, brings more volatility and also more winners and losers. We're starting the year with volatility in rates, volatility in currencies, and also repricing of the Ukraine risk, which we have been discussing over the past quarters and we're positioned for. And with that, I would bring it to the Q&A and ask you to type any questions in the chat. And I think we have already a couple over the last few minutes.
Yeah, perfect. Thanks, Alberto. So if I can just take there's three questions, but I'm gonna summarize them in two to begin with. So the first question is an interesting one, and one that we've been getting from a lot of investors, which is there seems to be this conflict between the different Trump agendas, which is want risk assets higher, wants the S&P higher, but at the same time wants to fiscally spend and prevent sort of yields from sort of, going further, which would obviously cause some kind of risk asset correction. So how should we be thinking about that contradiction? Which might eventually win? If you can talk us through the team's thoughts around that, that would be really helpful.
So I think here the philosophical question is that we have Western economies that have been consuming more than they produce, and they are now overlevered. And the US and other Western economies are struggling with a high level of debt and how to fund that debt. So the Trump administration has been discussing, making deals with foreign countries to fund long-term US debt. But obviously, the Eastern countries, the commodity producers and the net buyers of treasuries have also, shown reluctance to continue to buy treasuries, and in some cases they want to develop alternative currencies. So there's a financial system conflict there. If we think that the U.S. economy cannot tolerate a yield level of 6-7%, especially if it goes there very quickly. So central banks have been very careful in managing the rise in long-term yields. We think they will continue to do so, and if yields go up very quickly, they might reduce quantitative tightening. Every central bank is dependent on the leverage in the system that they deal with from a financial stability perspective. In the US, we have overhangs in the equity market. In the UK, we have overhangs in the property market. And in Europe, it's BTPs, it's Italy's sovereign debt. So you could say that every economy has a financial fragility. And if in the US, duration yields spike very quickly, then the equity market can have trouble, but also some of the banks that have a lot of duration. So if the central banks saves bond markets from, prevents bond markets from steepening and reduces the amount of quantitative tightening, then this becomes a trading currency. So essentially central banks will have to choose between financial stability and price stability. I think the Fed has more room, though, to let yields rise if the economy reaccelerates than, for example, the Bank of England, which is a lot more, where the economy is a lot more vulnerable and property prices have been stagnating. And obviously, Brexit has reduced the amount of investment. So, for example, we would see at some point, the Fed protecting the credit market, protecting yields from going much wider, and maybe going into a slightly weaker dollar environment. But before that, I think the Fed will try to lean hawkish. Well, the Bank of England probably will not even try that much and will follow more closely the ECB. So when we have a credit overhang, there's always two ways to absorb debt. One is inflation, one is restructuring. And some governments might choose to keep inflation running above target. And as a result, what we do in our strategy is when there are dislocations, we don't just want to buy paper assets like a normal bond, but there are convertible bonds and there are other assets that have upside that goes together with commodity prices or with an earnings stream that follows inflation. And those are the things that we love medium term because they have more linkage to the fiscal spending that governments will inject in the future.
Perfect. So Tao, actually, there are a couple of questions here on tariffs, but specifically, some of the China impact. So if I can just summarize them, if we think about Alberto's point before, which is there seems to be more room for yields to rise because the US can effectively withstand it, given where growth is. So it doesn't necessarily have to be a trade-off. In China, obviously, there's been, quite significant quantitative, there's been significant quantity easing sort of over the last few months. How should we be thinking about Chinese growth in the next year? Is it a headwind or a tailwind for global growth? And then also just to sort of tag on to that, how should we be thinking about their reaction function to, the Trump tariffs, whether it's 10% or 20%?
Yeah, sure. I think for China, going to 2025, obviously it is still going to be quite challenged, both because of the external pressure, like from the tariffs, which we are talking about, 10 to 20% potentially, but also because it still faces a lot of internal issues, like in the property markets and in the over capacity in some industries, and also the slow catch up in the consumption as a growth engine. However, having said that, it is probably going to be a slower or a smaller drag to the economies with exposure to China this year compared to the previous year. Why do I say that? Firstly, because cyclically we are seeing some improvements in the Chinese economy. We can both see in terms of PMIs, in terms of the latest Q4 GDP, and in terms of retail sales. Part of that is coming from the stimulus announcements we have seen so far, but partly is also because there is some bottoming out in the property markets, and we are seeing some signs of recovery and a little bit of sequential improvement in sentiment. But more importantly, it's because I think the governments in China, they will continue their easing programs. Both the Ministry of Finance and the PBOC have recently reiterated their stance towards more policy easing. For the Ministry of Finance, they have said there will be potentially higher official deficit and also higher debt. And also the PBOC have been again saying they will be having this moderately loose policy stance, which in a sense, it's like they are trying to manage the downside for the economy. However, some investors have been looking for some punchy numbers, some big measures, and I think those people probably will get a bit disappointed because the easing measures from the governments are still likely to be quite measured, quite incremental, and almost reactive. As I think so far we are not seeing a lot of detailed numbers, detailed measures. It's also because they are just waiting to see more details from the US in terms of the tariffs, in terms of how the negotiation is going to go, and then they are going to be reactive and using the easing to offset some of the external pressure. And we are likely to get more details on the specific measures and the two sessions meeting in March, where they will announce the official GDP growth target for this year, and also the official deficit target, their bond issuance targets for this year, which we are likely to see a step up, but still it's going to be a bit measured, a relatively small or moderate increase. So overall, I think for China, in terms of growth, both for this year and over the next coming years, we are probably still going to see like a gradual slowdown, structural slowdown in the trend growth. But it will still be positive. But at the same time, the sort of deflation issues, Japanification, slow Japanification issues probably still will be there, just because the government has chosen to take a incremental and modest easing stance towards the economy. Thanks.
Thanks, Tao. I think we have one last question.
Yeah, so it's an interesting question. I'm gonna paraphrase it. But essentially, what we've seen over the last sort of year is that we've seen a significant number of sort of refinancing transactions in the secondary credit market being taken out by private credit. How should we basically be thinking about the effect of private credit on secondary markets, not just in spread terms, but also in sort of volatility terms?
Yeah, so essentially there's been a lot of investor interest in locked long-term private strategies, and that has capped the volatility of the liquid market and has capped the downside. Why have investors put capital into private strategies that generate not so high return? For example, the return on private credit has been 9% net over the last 4 years with a long-term lock and lower ratings, lower quality. Well, one reason is that yield curves have been very inverted. So on the one hand, we have a buffer of assets that have been committed to long-term capital, and it caps the volatility of liquid markets. But on the other, we also have to keep in mind that a lot of these companies that have funded in the private market sometimes are the companies that couldn't fund in the public space. So if yields disinvert, if the yield curve goes to a positive above 5% level for some time in the long end, that will mean that investment grade yields will be 7%, and therefore a 9% net return on private credit on average is not very interesting anymore. So we could see, we've already seen some smart investors moving out of these strategies. We're probably past the peak, and it is a factor to keep into account when we look at volatility and the range of spreads, but it's not the main factor that it's by far not the main factor that we include in our investment process. But yeah, technicals have been positive. It comes down to the inversion of yield curves, but this can change. And if it changes, then we'll see a lot more dispersion in the credits that have been amending and extending or kicking the can, for example, with a 10% haircut rather than having a 20 or 30% haircut. We have a few examples in Europe, for example, across the water utilities in the UK, or some of the debt collectors. So, they got a soft haircut the first time. They might get a decapitation the second time. So we want to steer away from those credits that are still unsustainable, and they got a lot of help because long-term capital has been cheap. We want to be able to capture that volatility, and we have most of our personal capital in our strategy because we believe that volatility will create opportunities going forward. We definitely don't want to lock capital at single-digit yields right now. And I think this concludes our first call of the year. We'll be back in a few months. Thank you.